Welcome to Breaking News to Trading Moves. Imagine spending billions in capital to build the car of the future. You are entirely retooling your manufacturing process and altering your corporate identity, only to realize the market simply wants your classic gas-guzzling pickup truck.
Yeah, that is the exact reality check General Motors just handed the auto industry.
Right. General Motors is raising its 2026 profit outlook. We are looking at the specifics of GM's stronger first quarter results today.
And those results are driven by resilient U.S. pickup truck demand, right?
Yeah.
Along with better pricing.
Exactly. Plus easing emissions rules and an expected tariff refund. So based on this information, we will directly map out the market winners and losers.
Yeah, for sure.
For you listening right now, consider the tension between the future expectations for electric vehicles and the present-day profitability of traditional trucks. The market message is simple, really. Profitable trucks and SUVs still matter.
They really do. While investors focus heavily on EV growth, GM's update proves that margins, pricing power, and cost discipline take priority for auto stocks right now.
So let us get right into the first group of winners. We are talking about the traditional truck and SUV automakers.
Right, because we have an automaker adjusting its projections upward, and it comes down to what is working on the sales floor today. The focus has been on future technology for years,
Yeah.
But the actual mechanics of generating profit for General Motors right now rely on their established product lines.
GM's results show high-margin trucks and SUVs are performing well in the U.S. market because buyers are actively willing to pay for larger vehicles.
Absolutely. The easing of emissions rules gives them a longer runway to sell these traditional vehicles, right? They do not have to face those financial penalties or forced transition timelines that were previously hanging over the industry.
Right. Plus, factors like better pricing and an expected tariff refund provide a very tangible boost to their bottom line.
Exactly. It creates a clear dividing line between companies that can capitalize on this current environment and those that cannot.
So we are seeing a distinct preference from the market for companies that can generate cash today over companies promising to generate cash in the next decade. When consumers demonstrate they will pay a premium for utility and size, automakers with strong pickup and SUV lineups naturally see better sentiment.
Totally.
GM, General Motors, is the direct winner here because they are the ones who raised guidance.
And the same logic applies to Ford, and STLA's Stellantis. Both of those companies are heavily exposed to pickups and SUVs.
Wait, what is it about the manufacturing process for these specific vehicles that makes them so lucrative compared to, a standard sedan?
Well, it really comes down to the unit economics.
Yeah.
Building a large truck or an SUV does not cost an automaker proportionally more in raw materials and labor than building a smaller vehicle.
Oh, really?
Yeah. But the retail price tag is drastically higher. Automakers have spent decades optimizing the specific chassis and platforms used for these trucks. The engineering, research, and development costs were paid off years ago.
Oh, right. So they are essentially stamping out variations of a highly refined, heavily amortized product.
Exactly. So when a consumer pays a premium for a larger vehicle, the profit margin scales exponentially. The automaker captures the difference between the perceived value of that utility and the relatively stable cost of producing it.
So Ford, ticker F, and Stellantis, ticker STLA, rely on that exact same consumer base.
Yeah, their business models are structured around moving these high-margin, larger vehicles. A positive data point from General Motors serves as a strong indicator for the health of that specific market segment.
It makes me think of a restaurant that is famous for an experimental, highly anticipated new menu. They spent all this capital and marketing energy promoting these futuristic dishes.
Oh, I like that comparison.
Right.
Yeah.
But at the end of the day, when they look at their accounting, they realize it is their classic, reliable burger and fries that actually pays the rent and keeps the lights on.
Yeah, they can experiment with the new dishes because the core traditional menu items have such a massive profit margin.
Exactly. And those high-margin sales at the manufacturing level directly benefit the businesses selling those vehicles on the lot. Which moves us to the next set of winners, the retail and traditional auto suppliers.
Taking that restaurant analogy a step further, the suppliers are basically the farmers providing the ingredients for those reliable, high-margin menu items. And the retailers are the franchises selling them to the public.
The manufacturing level is just the start of the chain. Auto retailers and dealership groups are seeing a direct financial benefit from this consumer behavior.
Right. Because consumers are still spending on higher value vehicles, these dealership groups benefit from strong vehicle pricing. The economics of a dealership are pretty complex.
Yeah, auto retailers benefit from stronger revenue per vehicle, but they also see gains in finance income and used vehicle values.
Exactly. When the primary asset, the new truck or SUV, holds a high price, it elevates the entire ecosystem around it.
So for you keeping track of the specific companies positioned here, the auto retailers to watch are AN, AutoNation, LED, Lithium Motors, and PAG, Penske Automotive.
Let us break down how that dealership ecosystem actually works. If a consumer is buying a higher value vehicle, the dealership is not just making money on the metal itself, they are making money on the loan.
Right. The finance income generated by the dealership naturally increases because they are originating larger loans and they take a percentage of that financing.
Furthermore, the used vehicle values stay elevated when the new models are commanding top pricing. If a new truck is incredibly expensive, buyers who are priced out of the new market turn to the used market.
Which drives up demand and pricing for the used inventory sitting on the AutoNation, Lithia, or Penske lots.
The used car lot is often the most profitable physical space for these auto retailers. High new vehicle prices provide a sturdy ceiling that pulls up the value of every pre-owned vehicle below it.
That makes total sense. Alongside the retailers, we have to look at the traditional auto suppliers. These are the companies tied to internal combustion vehicles, hybrid platforms, drivetrains, and seating.
Yeah, when automakers focus more on profitable current models and become more selective with their EV spending to reduce losses, these established suppliers win. General Motors showed that reducing EV losses can actively improve earnings,
While electric vehicles are part of the long-term plan, the timeline is stretching, right? And automakers are pivoting back to their core manufacturing strengths.
which directly benefits suppliers like BWA, Borg-Warner, LEA, Lear, and MGA, Magna International.
I have a question about that, actually. If automakers are becoming more selective with their EV spending to reduce losses, does that mean established vehicle programs are essentially acting as a necessary financial safety net for these traditional suppliers?
It absolutely acts as a safety net. These traditional suppliers, Borg-Warner, Lear, and Magna International, have physical infrastructure. They have long-term contracts and massive factory production lines optimized for internal combustion and hybrid systems.
Right. When the industry aggressively pushed toward pure electric vehicles, there was intense pressure on these suppliers to pivot. And pivoting requires immense capital expenditure.
Yeah, you have to buy new tooling, train workers, and essentially build parallel manufacturing processes while the old ones are still running.
So by automakers slowing down that transition and leaning back into their profitable established vehicle programs, they are providing a steady, reliable revenue stream.
Exactly. These suppliers can continue producing the parts they have already mastered without having to drastically overhaul their entire production model overnight.
But the exact decision to reduce EV spending and double down on profitable current models has direct negative consequences for companies solely reliant on the electric vehicle transition.
Yeah, that leads us right into the pure-play EV and infrastructure losers.
Pure-play electric vehicle companies face immediate pressure because GM's reduced EV spending reinforces the broader view that EV demand is slower or less profitable than expected. Investors are looking very closely at scale, margins, and cash flow.
We are talking about companies like RIVN, Rivian, and LCID Lucid. The scrutiny on them really comes down to the mathematics of an adoption curve.
Because their entire valuation is based on a specific rapid adoption curve for electric vehicles.
Right. Building a car factory requires billions in fixed costs before a single vehicle rolls off the line. If you build a facility designed to produce hundreds of thousands of cars, but consumer demand only supports producing 20,000, well, those 20,000 cars have to absorb the cost of the entire empty factory.
Wow, yeah. That is why scale is paramount. When a major player like General Motors signals that they are pulling back on EV spending because it is a drag on earnings, it forces the market to reevaluate that adoption curve.
Investors look at Rivian and Lucid, and they see companies that are still trying to achieve the scale necessary to turn a profit. If the overall demand for EVs is slower than anticipated, their path to achieving positive cash flow becomes much steeper.
Wait, hold on. I get Rivian and Lucid, but like grouping TSLA, Tesla in there feels wrong. Tesla already has massive scale.
I hear.
They have factories all over the world. They're churning out millions of cars. They are not struggling to achieve production volume in the way a newer startup is. So why are they sitting in the exact same basket of pressure?
Well, They have the production volume, but their current market valuation assumes perpetual aggressive growth in the overall electric vehicle sector.
Oh, I see.
Yeah, Tesla, ticker TSSLA, is priced not just as a successful automaker today, but as a company that will continually capture more and more market share in a rapidly expanding EV market. They are still a pure-play electric vehicle company.
Right, so when a massive incumbent like GM signals that consumer demand for EVs is softer or less profitable than projected, it damages overall EV sentiment.
Exactly. Tesla relies on mainstream consumers, the people who currently buy gas-powered trucks and SUVs, eventually making the switch to electric.
Yeah.
If that transition slows down, Tesla's growth targets become harder to hit.
Even with their established scale, weaker overall EV sentiment negatively affects them because they need the entire pie to keep growing to justify their valuation.
You nailed it. The broader market sentiment pulls them down because their stock price is a reflection of future growth expectations. That holds true regardless of their individual operational scale today.
And this slower EV adoption does not just hurt the vehicle manufacturers, it severely hurts the infrastructure built around them. EV charging and battery-related names are hit hard here.
Oh, definitely. Charging companies need utilization, which means they need more EVs on the road actually plugging into their stations. Battery companies need scaling production to justify their operations.
So we are looking at charging companies like CHPT, ChargePoint, and BLNK, Blink Charging, along with battery technology names like QS, QuantumScape.
The business models for those charging and battery companies are entirely dependent on volume. Think of an EV charging station like an airplane seat.
Okay, how so?
Well, if an airplane takes off with half its seats empty, the airline loses money on that flight. If an EV charger is sitting empty in a parking lot, it is losing the company money every minute.
That is a great way to put it. A company like ChargePoint, ticker CHPT, or Blink Charging, ticker BLNK, requires high utilization rates to offset the massive capital expenditure of physically installing those stations, laying the concrete, and connecting to the electrical grid.
Right. So if EV adoption takes longer than expected, those chargers sit idle, and the math simply does not work.
And the same applies to QuantumScape, ticker QS. They need absolute confidence that EV production will keep scaling upward, so automakers will buy their battery technology in massive quantities.
General Motors' update slows expectations for any company where the entire investment case depends on rapid, near-term future adoption.
But electric vehicles and their infrastructure are not the only ones feeling the pinch. Traditional suppliers also face risks when automakers try to protect those high margins we discussed earlier.
Yeah, which brings us to the final group, the cost-sensitive supplier losers.
GM gave a specific warning about raw material, chip, and logistics costs. Cost-sensitive auto suppliers face severe margin pressure when automakers demand more efficiency, change their production schedules, or push back on pricing.
We're talking about names like APTV, Aptiv, ALV, Autoliv, and Modine Manufacturing. This is really the hidden friction in the supply chain.
Because while automakers like GM are enjoying better pricing at the retail level, they are simultaneously managing their internal costs very aggressively, right?
Exactly. The relationship between an automaker and a Tier 1 supplier is heavily weighted in favor of the automaker.
So when raw material costs, semiconductor chips, or global logistics become more expensive, the automaker does not want to absorb that financial hit. They turn to their suppliers and demand efficiency.
And those suppliers operate on fixed-price contracts. If the cost of the steel or the microchips required to build a component goes up, the supplier cannot simply send a higher bill to the automaker.
Yeah, the automaker refuses to pay more for the parts. If an automaker changes a production schedule, the supplier is left managing the logistical fallout and the carrying costs of excess inventory.
It is a really rough spot to be in.
It is like a game of hot potato, but the automakers are wearing oven mitts.
Oven mitts, I like that.
Yeah, the automakers feel the heat from rising raw material and logistics costs, and they immediately pass that hot potato down the supply chain. They have the pricing power, the oven mitts to protect themselves.
And the Tier 1 suppliers, the companies making the electrical architecture, the safety systems, the thermal management component, they do not have those mitts.
Exactly. They are forced to eat the cost. They're effectively watching their own margins shrink just to keep the contract and maintain the automaker's efficiency.
The suppliers left holding the potato include Aptiv, ticker APTV, Autoliv, ticker ALLV, and Modine Manufacturing, ticker MOD.
Are suppliers like Aptiv, Autoliv, and Modine Manufacturing highly sensitive to these cost fluctuations just because they operate on tight margins to begin with?
Yes, precisely. Their business model relies on high volume and incredibly steady, predictable production schedules. When an automaker pushes back on pricing, these suppliers have very little leverage.
I assume if they try to force a price increase, the automaker will simply resource the component to a competitor for the next vehicle cycle.
That is exactly what happens. Therefore, they have to find ways to absorb the higher costs of chips or raw materials internally, which directly impacts their profitability.
So even within a traditional auto industry that is performing well at the top level for the manufacturers and the dealerships, the financial pain of inflation and logistics is pushed downward onto the cost-sensitive
Right.
suppliers.
It is a complex web.
Well, we have mapped out the entire landscape based on GM's update. From the traditional automakers and retailers cashing in on the mechanics of consumer demand for large vehicles.
Right down to the pure-play EVs and infrastructure companies struggling with the mathematics of a slower transition.
And finally, to the suppliers caught in a margin squeeze driven by supply chain power dynamics. For you, the listener, I want to leave you with a final thought to explore on your own.
So this is a good one.
If easing emission rules and current consumer appetite for large trucks are keeping internal combustion engines so profitable right now, what happens to this exact ecosystem of winners and losers if those emission rules tighten up again in the near future?
Yeah, that is something you definitely have to watch.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.